GameStop stock skyrocketed 1,600% in a month, erasing $12 billion from hedge fund short positions. The blow came in 2021, targeting firms like Melvin Capital, which lost 90% of its assets overnight. Yet this wasn't just a stock rally, it was a calculated attack by Reddit users with no trading experience. The short squeeze exposed how institutional power could be undermined by social media-driven retail fury. It revealed years of market imbalances, regulatory gaps, and the weaponization of online communities against Wall Street. The short squeeze wasn't just about numbers. It was a psychological warfare tactic, exploiting the herd behavior of thousands of traders who, for the first time, felt they could challenge the financial elite. The hedge fund Melvin Capital, which had bet $5 billion against GameStop, saw its assets evaporate in days, while Robinhood, the brokerage platform, temporarily restricted trades on GameStop, citing a $50 million liquidity crisis, a move that sparked accusations of stakeholder manipulation and corporate restructuring under duress. The event shattered the illusion of Wall Street's invincibility, revealing how asymmetric information exploitation could be turned against the very institutions that had long controlled the market. The short squeeze wasn't just a stock market anomaly, it was a seismic shift in power dynamics, fueled by the rise of algorithmic trading, the collapse of trust in traditional gatekeepers, and the raw, unfiltered energy of a generation of investors who had never before held such leverage. The boardroom is a battlefield. If you don't know the rules, you're already losing. In January 2021, retail investors flooded GameStop stock, triggering a short squeeze that forced hedge funds like Melvin Capital to liquidate billions in losses. This was a textbook case of asymmetric information exploitation, where retail investors used public forums to outmaneuver institutional players who had monopolized market data. The move harnessed herd behavior and FOMO, turning a niche stock into a cultural phenomenon that destabilized Wall Street's power hierarchy. Robinhood, the brokerage platform, temporarily restricted trades on GameStop, citing a $50 million liquidity crisis, a move that sparked accusations of stakeholder manipulation and duress. Now is gen appes prakwijs zat het hopping I other charkum. O het chouten. Het strutkin via parkdash. And shirtik. And stress. And stress. And truck. King. Aman shant. Frontin at the end. And chuck. And chuck. And chuck. Aman chuck. Done. And Jan chuck. Jan. Done. 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 And chuck. The short squeeze wasn't just a stock market anomaly, it was a seismic shift in power dynamics, fueled by the rise of algorithmic trading, the collapse of trust in traditional gatekeepers, and the raw, unfiltered energy of a generation of investors who had never before held such leverage. The boardroom is a battlefield. If you don't know the rules, you're already losing. The event exposed a critical weakness in the system. The organizational hierarchy of Wall Street, which had long relied on institutional dominance, was unprepared for a decentralized, emotionally driven force. As the S&P 500's long-term growth had shown, markets thrive on stability. But the GameStop rally revealed how easily that stability could be shattered by a coordinated retail attack. The Dodd-Frank Act of 2010, designed to prevent systemic risk, was criticized for failing to address algorithmic trading and social media's role in market manipulation. This wasn't just about numbers, it was a psychological warfare tactic, exploiting the herd behavior of thousands of traders who for the first time felt they could challenge the financial elite. The 2008 crisis had shown the dangers of unchecked speculation, but the GameStop event proved that even the most resilient institutions could be undone by a surge of collective action. The hedge funds, once the architects of market control, were now the ones scrambling to survive. The boardroom is a battlefield. If you don't know the rules, you're already losing. The short squeeze exploited herd behavior, a psychological principle where individuals follow the actions of a group even when irrational. Behavioral economist Robert Cialdini, in his seminal work Influence, explains that asterisk social proof becomes a weapon when amplified by platforms like Reddit, which turn individual traders into a collective force. On r/Wall Street Bets, posts about GameStop didn't just spread, they cascaded. Each upvote, each comment, each buy cry became a signal to others, creating a feedback loop that turned skepticism into frenzy. The illusion of control was weaponized. Retail investors, armed with nothing but a smartphone and a brokerage account, felt they were part of a revolution, even as their decisions were driven by emotion, not analysis. Loss aversion framed the entire event. Retail investors, many of whom had never traded before, were motivated by the fear of missing out, a psychological trap where the pain of a missed gain outweighs the pleasure of a realized profit. Vanguard studies show that retail investors underperform the S&P 500 by 4–5% annually, often due to panic selling during downturns or chasing hype during rallies. In GameStop's case, the rally wasn't about fundamentals. It was about FOMO-driven, a term that became a rallying cry. As one user wrote in a viral post, "If we don't do this, we'll regret it for the rest of our lives." The emotional calculus was clear. The fear of regret outweighed the risk of losing money. Hedge funds like Melvin Capital, which had bet against GameStop, displayed Machiavellianism by leveraging asymmetric information to dominate the market until the tables turned. Their strategy relied on the assumption that institutional players could control retail noise, but they underestimated the power of a decentralized, emotionally driven force. As Kahneman and Tversky's work on cognitive biases shows, even the most rational minds are susceptible to confirmation bias when faced with a movement that feels inevitable. Melvin's analysts, poring over data, missed the emotional undercurrents of a generation that had finally found a way to fight back. The boardroom is a battlefield. If you don't know the rules, you're already losing. Phase 1. Retail investors on Reddit identified GameStop as a target due to its over-leveraged short positions and low institutional coverage. The stock's price had been crushed by hedge funds betting against it, creating a perfect setup for a short squeeze, a tactic where rising prices force short sellers to buy back shares at inflated costs. These investors, many with no prior trading experience, saw an opportunity to exploit asymmetric information. They dissected SEC filings, noticed the extreme short interest, and realized that even a small price increase could trigger a domino effect. Phase 2, they coordinated via social media to buy shares en masse, triggering a short squeeze that forced hedge funds like Melvin Capital to cover their positions at any price. Posts on r/Wall Street Bets became viral rallying cries. Buy the dip. This is our moment. We're not just investors, we're revolutionaries. The sheer volume of retail orders overwhelmed market makers, who had no choice but to buy shares at escalating prices. Hedge funds, desperate to minimize losses, scrambled to liquidate positions, further driving the stock higher. Phase 3. The resulting market volatility exposed the fragility of organizational hierarchy in Wall Street, where institutional investors had long held unchecked power. Robinhood, the brokerage platform, temporarily restricted trades on GameStop, citing a $50 million liquidity crisis, a move that sparked accusations of stakeholder manipulation and corporate restructuring under duress. Short sellers like Melvin Capital failed to anticipate the strategic ambiguity of a decentralized, emotionally driven retail force. Their reliance on Machiavellianism, leveraging asymmetric information to dominate the market, collided with a new reality. Power no longer flowed top-down. The Dodd-Frank Act of 2010, designed to prevent systemic risk, was criticized for failing to address algorithmic trading and social media's role in market manipulation. Regulators were left scrambling to define new rules for a landscape where retail investors could weaponize platforms like Reddit to destabilize Wall Street's power structure. The boardroom is a battlefield. If you don't know the rules, you're already losing. Recognize herd behavior in your own decisions. If a stock is trending on social media, ask, is this a bubble or a legitimate opportunity? During the GameStop rally, traders like Sarah Chen, a 28-year-old teacher with no trading experience, followed Reddit threads blindly. Her portfolio went from $10,000 to $250,000 in a month, then vanished when the stock collapsed. The lesson: herd behavior is a trap. Use diversification to mitigate risk. As Vanguard studies show, retail investors underperform by 4–5% annually due to emotional decision-making. In 2022, a retiree named Thomas Lee lost 70% of his savings chasing AI stocks, convinced by viral TikTok videos. His mistake: putting 80% of his nest egg into one sector. The fix: spread investments across asset classes. Use asymmetric information responsibly. Follow regulatory updates, for example, to spot corporate restructuring, or hostile takeover strategies. In 2023, hedge fund manager Elena Morales uncovered a merger plan by tracking a company's sudden increase in debt, $500 million in 6 months. She shorted the stock before the deal was public, netting 30% returns. The takeaway: power lies in seeing what others miss. The boardroom is a battlefield. If you don't know the rules, you're already losing. Subscribe for more breakdowns of corporate power psychology. Tell us in the comments, what's the most ruthless power play you've witnessed at work?